I'm Glenn Freeman from Morningstar, and I'm joined today by Shane Oliver, Chief Economist and Head of Investment Strategy for AMP Capital. Shane, thanks for joining us.
My pleasure. Great to be here.
Shane, what's your assessment of Australian listed companies' performance, given that fiscal 2016 has now ended?
Overall, I thought the reporting season was okay. I mean, it wasn't going to be a great year because, don't forget, resources companies have been hit by a massive blow from the falling commodity prices. So that really dragged down the resources part of the market. And of course, that flowed on to the rest of the market. So overall profits were down about 8%. But just bear in mind, there was a 47% odd slump in resources sector profits. So that's what really dragged it down. But if you sort of look in the details, they weren't too bad. You can see the median company actually saw profit growth of around 4 or 5%. 62% of companies actually saw their profits rise from a year ago. And most companies, or a majority anyway, over 50% of companies when they reported their results actually saw their share price outperform the market on the day of release. In other words, the market took the results reasonably well. And I think the other thing is that this has sort of set a base for a bounce back in profits as we go through the current financial year. So I think that's the really important thing from this. There wasn't a lot of disappointment. If anything, there's a slight upgrade to earnings, particularly for resources stocks. And as they go from being a big negative to being a positive, that should drag overall profit growth for listed companies over the next 12 months up to around 8% after the falls of the last year.
And were any of these sector results particularly surprising for you?
There were a couple of sectoral results that did surprise me. The resources perhaps were one of them. We'd been used to resources companies surprising on the downside, but you saw a few key companies there actually surprised on the upside. And that's why you saw upgrades to earnings expectations for the resources sector. BHP, Rio, Fortescue even. Results there I thought were a lot better than feared and probably better than I was expecting. The other area of surprise was what's often called discretionary retail. These are retail companies focused on discretionary spending items as opposed to consumer staples like supermarkets. And the discretionary retailers saw pretty good results. Now, part of that was driven by a great company, JB Hi-Fi, doing well or continuing to do well. But part of it generally, I think, was consumer spending coming back. We have seen reasonable growth in consumer spending over the last 12 months, albeit still a very competitive environment. Lots of weakness in terms of pricing power, but in terms of volumes, they seem to be coming through, and that's helping retailers.
Now, Shane, especially in the SMSF sector, we hear a lot about an over-allocation to Australian shares. Is this something that you see as a problem?
Well, there's positives and minuses with an allocation to Australian shares. I think the reality is that Australian shares do provide a good cash flow, and you get the franking credits. So you're always going to buy. So if you've got your investment portfolio and you're an Australian-based investor and you get access to those franking credits, you're going to have a bias towards Australian shares. The trouble is, I think that some SMSF investors do take it a little bit too far, and you end up with a situation of having too many of your eggs in just one basket. And if we go through a period like the last 5-6 years where Australian shares underperform, say, global shares, then that can actually be a negative for your wealth. Even though you're getting the income flow, you're not getting the capital growth that global shares offer you. So I think, there is a bit of a problem there that I wouldn't go full hog and say, well, I only have 1 or 2% in Australian shares. Like, if you're a Martian, that's probably all you'd have in Australian shares. So I'd still have a decent bias towards Australian shares, but I think it would make sense for investors to have a bit more internationally, given the sectoral exposure you get internationally, particularly IT stocks, consumer stocks and so on, that you don't have in Australia, the growth potential globally, and also the diversification benefits. You often find that when Australian shares are underperforming, global shares are doing better, and that helps protect your portfolio. And likewise, when you go global, depending on how you do it, you get exposure to foreign currency. And, just as the Aussie dollar's gone down over the last few years, foreign currency's gone up in value, and that also helps your portfolio.
Now, just further to that last question, do you believe that Australian SMSF investors are active enough in their asset allocation approaches?
So on the one hand, you can say that the old set and forget approach that we had through the 80s and the 90s, where you could just put some money down in an investment, and most things did pretty well through that period, apart from occasional setbacks, because we saw a very favourable environment economically and also financially. The tide was rising, all boats were being pulled up. You didn't have to put a lot of effort into trying to get the cycle right. Now we're going through an environment which is a lot more constrained, a lot more volatile, and therefore there is a case to employ a more active approach to asset allocation. The problem is, for individual investors, it's very hard to get that right because you're bombarded with information. There's multiples of information flowing these days that wasn't around around in the 80s or in the 90s, and that can be very confusing. It can throw investors off. So I think they have a choice here. Either you adopt the set and forget approach, but got to bear in mind you're going to get more volatility and lower returns than you got in the past, or you go down the path of saying, I'm going to do this myself, but I'm going to put the effort in, I'm going to make sure I get the right information flows and I get a process to help me through that. And you've got to beware here, you do have to put a lot of effort in, or alternatively, you invest in vehicles that might help you do that. You know, funds which do a bit of asset allocation as part of that process.
And just lastly, you've spoken about the likelihood of a residential property slowdown in our capital cities. Should SMSF trustees rebalance their portfolios away from direct property?
I think now's not the time to be heavily investing in or exposed to residential property, but it depends on which city you're in. I think the reality is in Sydney and Melbourne, we've seen fantastic gains over the last 4 years. 40, 50% gains in Sydney, a little bit less in Melbourne. So that's going to come to an end. The cycle doesn't keep going up forever. Sooner or later, you're going to get a bit of a downswing, and you're not getting a lot of rental growth through. Rental yields on average are pushing down below 3%. So that's not a positive either. And in the meantime, you've got this massive construction cycle. You look over the horizon in Sydney and Melbourne, and to a lesser degree Brisbane and Perth, you see cranes all over the place. And that's going to put downwards pressure on apartment prices over the next few years. So I'd be a bit cautious about the residential property markets, particularly in Sydney and Melbourne. I'd focus more, if I was intent on having an investment property in those cities, I'd focus on areas where you don't have lots of cranes, you don't have a lot of supply hitting, but you've got to really do your homework now. It's not as easy as it was, say, 4 years ago. And I'd probably be looking, if I was going to allocate more money in, I'd be looking at cities which have been underperforming in recent years. I prefer Brisbane over Sydney, for example, because Brisbane's been lagging. At some point in time, you might say, well, let's allocate some money to Perth or Darwin, which have been seeing price falls, so value is starting to emerge there. I think it's got a little bit further to go there, so I'll rush in right now, but over the next couple of years worth looking at. But I think the property asset class, which is probably a better bet at the moment, is commercial property. Commercial property has been doing well, but it's been lagging what you've been seeing in, say, Sydney and Melbourne. And it doesn't have the potential oversupply problems. And by commercial, I mean office, retail, industrial sort of property. So I think if I was an SMS investor, I'd be focusing on commercial, and I'd be focusing on cities which haven't had the huge gains and where there isn't the big supply if you are going down the residential property path.
Shane, thanks very much for your time.
It's been my pleasure. Great to be here.
I'm Glenn Freeman for Morningstar. Thanks for watching.